how does a company increase its top-line revenue by, a very respectable but ultimately modest 10%, and then miraculously skyrocket its net income by 85% in that exact same quarter?
Yeah, that's the kind of mathematical paradox that makes you immediately skeptical, right?
Exactly. Usually when you see a divergence like that on an earnings report, you're looking at, voodoo math. You immediately start hunting through the footnotes for some one-off asset sale.
Right, or like a creative accounting trick that artificially pumped up the bottom line. Because in the physical manufacturing space, margins are fought for, tooth and nail.
You don't just accidentally stumble into an 85% profit surge on a 10% sales bump.
No, absolutely not. It takes a massive structural shift to pull that off.
Well, welcome to a special Talk Tickers edition of the Deep Dive. We are taking that exact paradox and really dissecting it today, focusing squarely on the Q2 2026 earnings call for Allient, ticker symbol ALNT.
And if you're managing your own portfolio, our mission here is to aggressively filter the signal from the noise. We're bringing the raw data, taking the definitive stance on the results, and pulling out the actionable intelligence you need.
Right, especially if you're holding or considering a position in this mid-cap industrial player, because context is everything here. If you've been tracking Allient, you know this is a company executing, honestly, one of the most fascinating structural pivots in the industrial sector right now.
Oh, for sure. Historically, their bread and butter had heavy exposure to legacy, highly cyclical vehicle markets. We're talking power sports, consumer ATVs, specialized steering applications.
Which paid the bills, but it tethered their fate to consumer discretionary spending.
Exactly, and volatile interest rate cycles. But they saw the writing on the wall. Over the last few years, they've aggressively reallocated capital and engineering resources away from those legacy markets.
They are steering the ship directly into some of the most capital-intensive, explosive secular growth trends of this decade. They are morphing into a pure-play infrastructure and advanced robotics company.
Right, specifically embedding themselves deep into the supply chains for AI data center infrastructure, advanced aerospace and defense robotics, and high-end industrial medical automation.
It's not just a change in what they sell. It's a fundamental rewiring of the company's margin profile.
Yeah, they're trading consumer cyclicality for enterprise secular growth.
Which brings us right back to that mathematical paradox I mentioned at the top. Let's look at how that structural pivot actually showed up on the income statement this quarter. I want to dig straight into the top and bottom line data.
Let's do it.
So they posted revenue of $153.8 million, which is that 10% year-over-year increase.
And, it's worth noting the organic growth underlying that. They did have a slight $1.3 million favorable tailwind from foreign exchange translation.
Right.
But even when you strip that noise out, organic growth was still 9%. So this isn't just an FX mirage. It's robust physical volume moving out the door.
9% organic is rock solid in this macro environment. But here's where the numbers get, frankly, violent. Net income hit $10.4 million, that massive 85% year-over-year increase.
Yeah, and if we look at adjusted EBITDA to gauge pure operational cash generation, that landed at $23.7 million.
Which represents a very healthy 15.4% of total revenue.
Exactly. Diluted EPS was 61 cents, with adjusted EPS hitting 80 cents. But to me, the metric that absolutely screams off the page, the one that actually explains this entire quarter, is the gross margin.
Oh, it's the star of the show. Gross margin hit a record level of 34.9%. That is a 170 basis point expansion year over year.
Which is huge. In the realm of physical goods manufacturing, where you are physically sourcing copper and steel, managing international labor forces, and shipping heavy equipment, a 170 BP's expansion is monumental.
Okay, I have to stop and unpack this, because this is where, the retail investor needs to separate a fundamentally improving business from a temporary blip.
Fair point.
When I see profit outpace revenue by a multiple of 8.5, my immediate thought is pricing power. Did they just aggressively hike prices across the board to squeeze their current customers?
Or is there actual sustainable efficiency happening under the hood, right? Because price hikes run out of runway eventually.
Exactly. You can only squeeze the lemon so much.
Well, it's the ultimate question for any long-term thesis on the stock. And the answer here isn't just arbitrary price gouging. To translate that 170 basis points, that's a 1.7% jump in profitability on the goods sold. And it comes down to three structural drivers.
Okay, what's the first one?
The first is pure operating leverage, specifically fixed cost absorption.
Walk us through what that actually looks like on the floor of an Allient facility. Like, how does that work in reality?
Think about the rigid nature of their overhead. The lease on the Wisconsin facility, the salaries of the plant managers, the depreciation of the assembly line robotics, the core IT infrastructure.
Right, those are fixed costs. They exist whether the plant is running at 60% capacity or 95% capacity.
Precisely. So when Allient drives 10% more revenue volume through that exact same physical footprint, they aren't incrementally increasing those fixed costs.
So the margin on that final 10% of production is exponentially higher than the margin on the first 10%.
You nailed it. The overhead stays flat, and that incremental gross profit drops almost entirely to the bottom line.
It's the beauty of industrial operating leverage. Once you cross the break-even point, every extra motor or filter you push off the line is just pure gold.
It really is. Now, the second factor, and honestly, this is the core of the bullish thesis going forward, is a highly favorable product mix.
Meaning they're selling different stuff.
Right. They are intentionally starving their low-margin legacy product lines of resources and prioritizing their premium, highly engineered solutions.
Which makes sense. When you change the overall composition of your sales to feature more high-margin items, the aggregate margin of the entire company naturally expands.
Exactly, even if you haven't raised the price on a single individual item.
And the third piece of the puzzle driving that net income spike, what was that?
Relentless debt reduction. In a high-rate environment, they generated enough cash to aggressively pay down their debt balances.
Oh, wow. So their interest payments dropped.
Big time. Interest expense actually declined by approximately $1 million year over year, dropping down to $2.5 million for the quarter.
So it's a perfect storm of execution, really. You have higher overall volume driving fixed cost absorption, a strategic shift toward premium products, and a shrinking debt burden.
Right, which stops cash from bleeding out to the banks. Suddenly, a solid 10% revenue gain mathematically compounds into an 85% net income explosion.
CFO Jim Michaud summed it up perfectly on the call, actually, citing that stronger mix, improved operating leverage, and lower interest expense as the distinct catalysts.
It's exactly what you want to see. The profit isn't coming from an accounting adjustment. It's coming from operational excellence.
But, the financials are ultimately just the scorecard. The numbers tell us the company is really profitable, but they don't tell us what specifically is driving the demand.
Right, the actual hardware.
Yeah, to really understand the durability of this margin expansion, we have to look closely at the physical hardware they are selling and the end markets they are serving. And there's no bigger driver for Allient right now than the AI and infrastructure boom.
It is the absolute centerpiece of their growth narrative. In Q2, sales tied directly to data center and infrastructure applications hit $16.3 million.
Wow. And what percentage of total revenue is that now?
That segment is now 10.6% of their total revenue.
And the growth trajectory is just vertical. That 16.3 million is up 60% year over year.
Yeah, and if you pull back and look at it on a trailing 12-month basis, data center sales hit $57.1 million, which is a 69% increase.
What's crucial for investors to understand, though, is that Allient isn't playing in the software side of AI. They aren't designing neural networks.
No, not at all. They aren't competing with the hyperscalers. They are solving a brutal physical bottleneck that is threatening the entire AI rollout.
Power quality.
Exactly, power quality.
This is where we need to dive into the engineering reality of these data centers. Because if you read through the transcript, management throws out terms like power quality layer, active and passive harmonic filters, line reactors, and helping customers achieve IEB 519 compliance.
It sounds incredibly dense, I know, but it is the exact reason why Allient has total pricing power right now.
Right. Because the broader market understands that AI data centers consume a staggering amount of raw electricity. But what is widely misunderstood is that it's not just about the quantity of megawatts.
Exactly. The far more critical issue is the quality and stability of that power.
I always think of the electrical grid like a highly pressurized municipal plumbing system.
Okay, I like this analogy. Walk me through it.
Well, the utility company is the water tower, and the grid infrastructure like the substations and power lines are the pipes. In a normal environment, the power flows smoothly, like a clean sine wave. You plug in your refrigerator, and it draws what it needs seamlessly.
Right, simple and clean.
But a gigawatt AI data center is not a normal appliance.
Not even close. Because of how these massive clusters of specialized GPUs operate rapidly switching heavy compute loads on and off millions of times a second to process complex algorithms, they act as massive disruptive loads on the grid.
So they don't just draw power, they actively distort the electrical waveform.
Yes, they literally warp it.
Going back to the plumbing analogy, it's like a massive industrial facility slamming its intake valves open and shut violently. It creates massive pressure spikes and harmonic distortion, essentially electrical sludge that flows backward into the grid.
And if you don't mitigate that sludge, those chaotic power surges will ripple back through the infrastructure. At best, they degrade the efficiency of the power network.
And at worst,
they literally fry the transformers on the grid and destroy the sensitive equipment of neighboring facilities.
and the stakes inside the data center itself are even higher, right? If you feed that dirty, jagged electricity into a rack containing millions of dollars worth of AI microchips, you are at a massive risk of hardware degradation.
Or catastrophic failure. You are dealing with the most expensive, supply-constrained hardware on the planet. Unplanned downtime or hardware replacement in these facilities costs millions of dollars an hour.
Enter Allient. They basically build the high-tech, industrial-grade water filters for the electrical grid.
That's exactly it. Their harmonic filters and line reactors sit directly between the raw grid power and the AI servers. They are engineered to absorb those chaotic spikes, smooth out the harmonic distortion, and output a perfectly continuous, clean stream of electricity.
So those delicate server racks can safely consume it.
You got it. And it's not just a preventative measure, by the way, it's a regulatory mandate.
Right, the IE 519 compliance management was talking about.
Yeah, that is the strict global engineering standard that dictates exactly how much harmonic distortion a facility is legally permitted to push back onto the grid.
And if a data center developer cannot prove they meet those standards,
the utility company will simply refuse to connect them. They will not allow a massive data center to destabilize their regional grid. Alliance equipment is the physical hardware that guarantees that compliance.
which fundamentally shifts how a data center developer views Allient's products. I mean, this isn't a discretionary accessory where they're trying to squeeze every penny out of the supplier.
No, this is mission-critical, mandatory infrastructure. If you are building a $2 billion hyperscale facility, you are not going to risk project delays or grid rejection by cheaping out on the power quality layer.
You want the absolute most reliable, highest performance solution available. And CEO Richard Warzala was very pointed on the call about their competitive advantage here. He stated that their active filter for data centers is currently the highest power solution on the market.
Yeah, and he noted it allows their customers to optimize their physical footprint, which is massive.
Why is the footprint so important?
Because floor space inside a completed data center is some of the most expensive real estate on Earth. If Allient can provide a single high-density active filter that does the job of 3 competitor units, it frees up white space.
Oh, space that the operator can use for more actual servers.
Exactly. That spatial efficiency is exactly why Allient can command a premium price and drive those 34.9% gross margins.
It perfectly illustrates the quality upgrade of their revenue streams we were talking about. Selling a highly engineered 519 compliant active filter to a hyperscaler gives you immense margin durability. But AI infrastructure isn't their only secular growth engine. We have to look at the Aerospace and Defense segment, which delivered a massive surprise this quarter.
It really did. A&D revenue increased 16% year over year,
Right.
which on its face is a very strong number.
Right.
But it becomes genuinely incredible when you realize the context they achieved, 16% growth, in the exact same quarter. They absorbed the total loss of a major platform contract.
You're talking about the cancellation of the M10 Booker program.
Yes.
For those unfamiliar, the M10 Booker was essentially the Army's new mobile protected firepower vehicle, a light tank designed for infantry brigades. Historically, for a mid-cap defense supplier like Allient, having a primary platform contract canceled by the Pentagon is devastating.
Usually it guarantees a multi-year revenue creator in that specific segment while you scramble to bid on new long-term platforms. The bespoke defense contracting model is brutal.
Because you spend years in R&D designing a highly specific, customized component for one vehicle.
What exactly? And if the politics change or the Pentagon shifts its doctrine and cancels the vehicle, all that future revenue evaporates instantly.
So how on earth does Alan Sharia absorb the loss of a major ground vehicle program and still accelerate A&D revenue by 16%? It doesn't make sense.
They did it by completely rethinking their defense strategy and leaning aggressively into the commercial off-the-shelf or COTS model, specifically targeted at the unmanned systems and drone markets.
Oh, that's a brilliant pivot away from the legacy defense contracting nightmare. Instead of spending 3 years tied up in red tape designing a bespoke propulsion motor for one specific drone.
Right. They are utilizing their deep engineering expertise in electromagnetics and lightweighting to build a standardized catalog of ultra-high performance components.
Which changes the entire sales cycle. A defense contractor tasked with building a new loitering munition or surveillance drone doesn't have the luxury of a 5-year development timeline anymore.
No. Modern warfare is evolving in months, not decades. That prime contractor can now go to Allient, pull a fully validated high-performance propulsion motor right off the shelf, and integrate it into their drone design immediately.
And Warzala noted they are heavily investing in this specific product line right now. They are soft launching these COTS propulsion solutions at ground-based vehicle shows in Detroit.
Yeah, and preparing for a massive full-scale launch at the AUSA Defense Trade Show in October. He also highlighted a crucial secondary market, which is counter-drone systems.
Now this is fascinating. As drone warfare becomes cheap and ubiquitous, the systems required to track, target, and physically neutralize those threats are becoming top priorities for the DoD.
And think about what a counter-drone system actually requires. It requires radar arrays and kinetic interceptors that can track a target moving at high speeds and adjust their physical positioning with zero latency.
And millimeter precision, I'd imagine.
Exactly. That requires the exact same advanced precision motion control and power stabilization technology that Allient has perfected.
Wow. So they are positioning themselves to sell the picks and shovels to both sides of the autonomous battlefield, the drones themselves, and the systems built to shoot them down.
It's an incredibly resilient revenue model.
It really is. But to keep this analysis objective, we have to flip the coin. We can't just champion the high-margin secular growth markets without addressing the drag on the portfolio.
Fair enough.
And the clear weak spot this quarter was the legacy vehicle market.
Yeah, revenue in the vehicle segment declined 7% year over year. CFO Michaud didn't mince words. He directly attributed the weakness to cratering demand in the power sports market.
Just to frame this for you listening, Allient's vehicle segment is a mix. It includes commercial components for buses, construction equipment, marine applications.
But the historical anchor has been specialized steering applications for consumer power sports, specifically ATVs and UTVs.
Right. And the macroeconomic environment for consumer ATVs is highly toxic right now. You have a combination of massively elevated interest rates, crushing dealer floor plan financing.
Yeah, and making consumer installment loans prohibitively expensive. Combine that with a broader tightening of discretionary spending, plus the massive pull forward of demand we saw during the pandemic.
And you have a recipe for a cyclical bust. On the earnings call, analyst Ted Jackson tried to pin management down on this. He was digging for granularity, trying to determine exactly how much of that vehicle segment is tied up in consumer power sports versus the more resilient commercial vehicles.
Management was very guarded with the exact breakdown. Warzala refused to give the specific sub-segment percentages.
Interesting.
He just reiterated their long-standing strategic goal to manage the automotive exposure down to less than 10% of overall revenues.
Though he did concede that while the commercial utility vehicles are holding relatively steady, the consumer recreational side is a significant drag.
He did.
Honestly, as an investor, this weakness fits perfectly into the broader bull thesis.
You think so?
Yeah. The consumer ATV market is the exact definition of a lower margin, highly cyclical, macro-dependent business. The fact that this segment is organically shrinking at the exact moment their high-margin data center and defense segments are exploding actually accelerates their transformation.
I see what you're saying. It is addition by subtraction.
Right. The faster they rotate away from consumer recreation and toward enterprise infrastructure, the faster their valuation multiples will re-rate to reflect that higher quality revenue.
It definitely improves the long-term durability of their earnings, but, we also have to acknowledge the execution risks along the way.
Oh, absolutely.
Shrinking segments aside, there is a very real operational bleed happening right now. They incurred $600,000 in restructuring costs this quarter alone, primarily tied to ongoing inefficiencies with a facility transition in Dothan, Alabama.
Yeah, the Dothan transition has been a persistent thorn in their side. Warzala was pretty blunt about it, admitting that the transition of a specific product line into that facility had not performed, quote, as we had expected in previous quarters.
It's a stark reminder that while the financials look great on a spreadsheet, physical manufacturing is exceptionally difficult.
So what's the actual issue at Dothan?
Well, the Dothan facility is dealing with a high-mix, low-volume production environment, which is inherently complex. You are constantly retooling lines for different product specifications.
Right.
When you try to transition new product lines into that environment, you are dealing with worker retraining, establishing new supply chain logistics, and maintaining incredibly tight quality control tolerances.
And when it misfires, the costs compound instantly. The production delays generated past due orders, forced them to incur premium freight costs to try and catch up, and required them to throw expensive engineering resources at the problem.
Exactly. Warzala noted they put a full court press on the Dothan facility to stabilize it. He says it is improving and they are working through the past due backlog, but they still anticipate $2 million to $3 million in total restructuring costs for the full year 2026.
And that full-year figure also includes forward-looking investments to optimize their Reynosa, Mexico facility.
Yeah.
So they are still in the messy middle of optimizing their geographic manufacturing footprint.
They are, which actually provides the perfect segue into the most heavily discussed operational topic on the call.
Oh, the STAN initiative.
Yes. Management spent a significant amount of time detailing their internal efficiency program, which they have branded STAN.
Right, which stands for Simplify to Accelerate and Now W.
Yeah.
Okay, as someone who has covered corporate earnings for a long time, I have an immediate allergic reaction to acronyms like this.
I don't blame you.
Usually, when a mature industrial company rolls out a cute acronym for an efficiency program, it's purely cosmetic. They hire a massive consulting firm, plaster the break rooms with posters about synergy, quietly lay off a layer of middle management to juice the quarter's EPS, and pat themselves on the back.
Oh, totally.
So is there actual structural substance to STAN, or is this just corporate theater?
Your cynicism is well earned. We've seen 100 of these programs fail to deliver real value. But with Allient, you have to look at the scoreboard. If STAN was just cosmetic fluff, it wouldn't manifest in a 170 basis point expansion in gross margin.
The numbers validate the narrative.
Exactly. And they provided very specific dollar figures for the cost takeout.
Right. They noted that the STAN initiatives generated $10 million in annualized savings in 2024.
And then it layered on another $6 million in structural savings in 2025. And looking ahead, Warzala stated they're targeting another $5 million to $7 million in savings for 2026.
Let's put that in perspective for a second. That is $21 to $23 million in permanent structural cost removed from the business over a 3-year period.
Yeah.
For a company doing roughly $600 million in annual revenue, pulling out $23 million in dead weight is profoundly impactful to the bottom line. So how are they actually doing it on the factory floor?
Well, Warzala stressed that it is supported by what they call AST Allient systematic tools. It's not just about headcount reduction. It's about attacking the quiet administrative bloat that plagues legacy manufacturers, especially ones that have grown through acquisitions over the years.
Think about the manual IT redundancy that builds up in these companies. You acquire 3 different smaller manufacturers over a decade, and suddenly you have 3 different facilities using 3 different legacy ERP systems.
Oh yeah, it's a nightmare.
You have procurement teams in different states buying the exact same raw materials at different price points because the systems don't even talk to each other.
Exactly. STAN is about standardizing those business processes globally. It's migrating everyone to unified systems, automating the manual data entry that slows down production planning, and centralizing procurement to maximize their purchasing leverage.
Makes sense.
But Warzala also highlighted the cultural aspect, the NNOW in the acronym.
Right. He described it as injecting a get-it-done mentality, focused on pushing decision-making power down the chain and removing bureaucratic obstacles.
When a plant manager sees an inefficiency on the floor, they shouldn't have to wait 3 weeks for a corporate committee to approve a $5,000 tooling adjustment. STAN empowers them to execute immediately. It's about increasing the velocity of the organization.
And that cultural shift, that increased operational velocity, is exactly how a company can absorb a 10% increase in production volume without bloating their administrative and operating expenses.
Yep.
It's the connective tissue that bridges the gap between strong revenue and explosive net income. Okay, we have thoroughly dissected the trailing 90 days. We know exactly how and why they drove such massive profitability this quarter.
We do.
But as investors, we know the market is a forward-looking discounting mechanism. Yesterday's execution is already priced in. What truly matters is the visibility into tomorrow. We need to look at the leading indicators, so let's analyze management's guidance for the back half of 2026.
If there's one metric from this entire report that should command the attention of anyone evaluating this stock, it is the order intake and the resulting book-to-bill ratio. Everything else is secondary.
The sheer volume of demand here is staggering. They recorded $201.3 million in new orders during the quarter,
Which is up 49% year over year.
and up 27% sequentially from just the first quarter.
And that tidal wave of new orders generated a book-to-bill ratio of 1.31x.
For those tracking industrial cyclicals, a 1.31x book-to-bill is the absolute holy grail of leading indicators. To frame it simply, for every $1 of finished product Allient managed to build and ship out the door in Q2, they legally contracted $1.31 in brand new orders.
Anytime that ratio dips below 1.0, you know a company is eating into its backlog just to keep the lights on. Revenue contraction is imminent. A ratio of exactly 1.0 means you are just treading water. But 1.31x means demand is violently outstripping their current maximum manufacturing capacity. They literally cannot build the products fast enough to satisfy the market. That $201 million in orders represents hard, contracted future revenue just waiting to be realized on the income statement.
Because of that massive intake, their total backlog has swelled to $298 million.
And management provided vital context on that backlog, noting that the vast majority of those orders are scheduled to convert to recognized revenue within the next 3 to 9 months.
Which provides incredible visibility for the second half of the year. But there was a fascinating moment during the Q&A session where analyst Greg Palm from Craig-Hallum really pushed on this dynamic.
Oh, that was a great exchange.
Yeah, he pointed out the math. If you have a $298 million backlog and it historically converts in 3 to 9 months, that implies an absolute explosion in revenue for Q3 and Q4. He wanted to know if that steep curve is actually what we should expect to see modeled out.
It was a very sharp question, and Warzala's answer revealed the complex realities of the current industrial supply chain. He acknowledged the massive backlog, but cautioned against modeling a sheer vertical revenue spike.
Why?
He pointed out that across the entire data center and infrastructure industry, component lead times have elongated significantly.
Because the sheer scale of the AI build-out is straining every tier of the global supply chain.
Exactly. So Allient has been proactively going to their major enterprise customers and telling them, do not wait until you actually need this equipment to order it. Our capacity is filling up. If you want guaranteed delivery in Q4, you need to place the order today to lock in your production slot.
So there is a behavioral shift happening. A portion of that massive 49% spike in year-over-year orders is actually customers strategically pulling their orders forward to de-risk their own supply chains.
Rather than a pure, sudden explosion in immediate spot market demand.
It's a crucial nuance. Warzala noted that they are seeing orders land on the books perhaps 3 months earlier than historical norms. However, he also revealed a countervailing factor that suggests their backlog number is actually highly conservative.
What's that?
They recently changed their internal accounting policy regarding how they record bookings. They are no longer putting large multi-year blanket orders into the official backlog metric unless the specific delivery releases are scheduled within a 12-month window.
Wow, that is incredibly conservative. They have visibility on massive long-term enterprise contracts, but they are purposefully excluding the out-year revenue from that $298 million figure because it's too far in the future.
Precisely. They are ensuring the backlog remains a pristine indicator of near-term cash flow, not a vanity metric padded with promises for 2028. Warzala also clarified for the analyst that in a typical quarter, roughly 20% to 25% of their total revenue comes from book and ship business orders that are placed and fulfilled within the exact same 90-day window, while the remaining 75% is steadily drawn down from that massive backlog.
So we have a $298 million wait list wrapped around the building and demand that is radically outpacing output. The obvious operational imperative is capacity expansion.
Right. How are they planning to build a bigger kitchen to serve these orders?
Management guided for full-year capital expenditures, or CapEx, to land between $12 million and $15 million. This isn't maintenance CapEx, just keeping old machines running. This is highly targeted growth capital.
Okay, where is it going?
The spend is aggressively focused on automation robotics and, most importantly, a major expansion of their data center production capacity.
Did they specify where they are deploying that capital geographically?
Yes. Warzala explained that the expansion is primarily centered in their Wisconsin operations, but it's being executed in tandem with their facilities in Reynosa, Mexico.
Utilizing a nearshoring strategy.
Exactly. They are shifting the more standardized, higher labor content manufacturing down to Mexico to capitalize on labor arbitrage. That frees up the floor space and the highly skilled technician labor in Wisconsin to focus exclusively on the complex, high-margin assembly required for the massive active harmonic filters.
It's a perfect optimization of their North American footprint. But the timing is the critical variable here. Having a mountain of orders is fantastic, but if you can't physically build the product, you can't build the customer, and the revenue gets pushed to the right.
Absolutely.
When does this new Wisconsin capacity actually come online?
Relief is imminent. Warzala stated he recently toured the facility and confirmed the expansion is well underway. The new capacity is scheduled to be fully online and contributing to revenue late in the third quarter or very early in the fourth quarter.
Which perfectly aligns with that 3 to 9 month backlog conversion window. Now, usually, when a mid-cap industrial company is growing 10% organically, absorbing a multi-million-dollar restructuring in Alabama, and dropping $15 million in cash to rapidly expand a facility in Wisconsin, you see their balance sheet deteriorate.
Yeah, they usually have to draw down heavily on their credit facilities to fund that kind of aggressive expansion.
Let's look at their financial health.
This might be the most impressive aspect of the entire quarter, and it speaks volumes about their capital allocation discipline. Despite aggressively funding that capacity expansion, and despite carrying elevated inventory levels to protect their supply chain from disruptions.
They still paid down debt.
Yes, they actually generated enough free cash flow to reduce their total debt by $7.1 million compared to the end of 2025.
Which brings their total gross debt down to $173.3 million.
And if you factor in the $42 million in cash and equivalents they are holding on the balance sheet, their net debt position is just $131.2 million. That brings their bank leverage ratio net debt to adjusted EBITDA down to an incredibly safe 2.07x.
Let's contextualize that for the listeners. In the industrial manufacturing sector, maintaining a leverage ratio under 3.0 is generally considered very solid. Anything under 2.5 is considered pristine.
So at 2.07, Allient has bulletproof financial flexibility.
Right. They aren't stressed by current interest rates, and they have massive dry powder. They explicitly noted they still have $162 million of completely unused capacity on their revolving credit facility.
To use your restaurant analogy, the wait list is wrapped around the block. They are paying straight cash to aggressively expand the kitchen and buy new automated ovens so they can serve twice as many tables. And despite all of that aggressive growth spending, they're simultaneously paying off the mortgage on the building ahead of schedule.
It is a masterclass in operational capital allocation. They are absolutely maximizing their structural growth opportunities in AI and defense without sacrificing the integrity of the balance sheet.
Before we move to the final verdict, we should briefly touch on a couple of minor guidance items they provided for the modeling crowd.
Okay, what do you have?
They anticipate a full-year tax rate landing in the range of 21% to 23%. They also highlighted a potential windfall regarding tariffs.
Oh, the IEPA refunds.
Yeah. As a global manufacturer, tariffs are a constant headwind, but they have officially submitted claims for approximately $1.3 million in refunds related to the International Emergency Economic Powers Act, or IEEPA.
Though I noticed CFO Michaud was very prudent about that. He explicitly stated they haven't recorded that $1.3 million as a receivable on the balance sheet yet, simply because the timing of the federal government actually cutting that check and processing the refund is entirely unpredictable.
It's smart conservative accounting. Don't count the government's money until it actually clears the bank account.
All right, we have torn this earnings report down to the studs. We've analyzed the underlying mechanics of the 170 basis point margin expansion. We've explored the explosive 60% growth in data center infrastructure and the strategic pivot to COTS and aerospace and defense.
We covered a lot of ground.
We've looked at the massive 1.31x book-to-bill ratio, the 15 million capacity expansion in Wisconsin, and the pristine 2.07 leverage ratio. It is time for the final verdict. As the resident analyst for this Talk Tickers deep dive, I am putting you on the spot.
Let's hear it.
Looking at the totality of the Allient Q2 2026 earnings execution and their forward guidance, what is your ruling? Bullish or bearish?
Based on the structural improvements we've seen today, I am taking a strong, unequivocal, bullish stance on Allient.
Break down the core thesis. Synthesize all this data into the fundamental why.
The core thesis is that Allient is successfully executing one of the most difficult maneuvers in the industrial sector, a massive quality upgrade of their revenue base. They are intentionally shedding low-margin, highly cyclical businesses like the consumer power sports market, which is currently dragging down their vehicle segment, and they are systematically replacing every dollar of that lost revenue with high-margin, incredibly sticky enterprise contracts in dominant secular growth markets.
AI data centers and autonomous defense robotics.
Exactly. When you sell a standard electric steering motor for a recreational ATV, you are competing in a commoditized market where price is the primary differentiator. But when you are selling a highly engineered, i.e. 519 compliant active harmonic filter that physically protects a $2 billion AI server farm from catastrophic electrical failure, you are competing purely on engineering excellence and reliability.
You possess absolute pricing power.
That fundamental shift in what they sell is exactly why their gross margin just expanded by 170 basis points. It is why their operating margins hit 10.2%, representing the highest level of profitability they have achieved in a decade.
So let's make this highly actionable for you listening right now. If you are sitting at home managing your own capital and you already hold ALNT stock in your portfolio, how should you react to this quarter?
If you are already holding ALNT, this earnings print should serve as massive validation of your long-term thesis. The margin expansion we are dissecting today is not a one-off accounting fluke, it is structural.
Right.
It is driven by a permanent upgrade in their product mix and the rigorous, ongoing operational discipline of the STAN initiative, removing millions in legacy costs. You hold this stock with confidence because the fundamental quality of the underlying business you own today is drastically higher than it was just 2 years ago.
And what if you don't hold the stock? If you are a listener who's evaluating Allient as a potential new position, what is the single biggest takeaway?
If you are considering initiating a position, the single most important data point that de-risks this investment is that 1.31x book-to-bill ratio.
Right, the pipeline.
Investing in mid-cap industrial transformations is inherently risky because you are usually waiting on faith for future demand to materialize. But with Allient right now, the demand is not theoretical, it is legally contracted. That $201 million in new orders significantly de-risks their revenue projections for the next 6 to 9 months.
The money is literally sitting in the pipeline waiting to be recognized.
Exactly. The balance sheet is pristine, the product mix is premium, and the end market demand is explosive. They just have to finish building out the Wisconsin facility to push the product out the door.
It is an incredibly compelling setup. They've essentially positioned themselves as a mandatory toll bridge on the road to the AI infrastructure build-out. Which brings us to the end of our deep dive analysis today. But before we sign off, I want to leave you, the listener, with one final, deeply provocative thought from the very end of the Q&A session.
Oh, this was a great moment.
Right at the end of the call, Jerry Sweeney from Art Actual Partners asked management a fascinating, highly specific question. He asked if Warzala could quantify the actual dollar value of the equipment Allient supplies per megawatt of data center power built.
And Warzala's answer revealed the true scale of their total addressable market.
It really did. Warzala explained that it depends entirely on the specific engineering design of the facility. On the low end, if a data center developer opts for a basic solution and just buys simple line reactors, Allient might capture a couple of $1,000s per megawatt.
Right, the basic tier.
But if the developer requires the complete high-end power quality solution integrating their communications gateways, their top-tier active and passive harmonic filters, and the fiber alignment equipment Allient is capturing upwards of $40,000 per megawatt.
$40,000 per megawatt.
I want you to let the math on that sink in for a moment. We are entering the era of the gigawatt data center. A single gigawatt facility is 1,000 megawatts. At $40,000 per megawatt, a single hyperscale data center project represents a potential $40 million top-line revenue opportunity for this one mid-cap company.
That is staggering.
Right now, the entire financial media and the vast majority of Wall Street are hyper-focused on the semiconductor giants. They are relentlessly chasing the shiny objects of the companies designing the actual AI microchips.
Sure.
But as you evaluate the allocations in your own portfolio, I want you to consider if the real undiscovered generational wealth in this infrastructure supercycle actually lies in the unglamorous picks and shovels companies.
The mid-cap industrials building the high-tech electrical filters that are quietly keeping those multi-billion-dollar AI chips from catching fire.
It's the oldest rule in investing. During gold rush, the surest bet is usually the company selling the picks and the shovels. And with that, we are wrapping up this Talk Tickers edition of The Deep Dive. Thank you for tuning in, for bringing your analytical rigor, and for navigating the complex realities of corporate finance with us. We'll catch you on the next one.